Welcome to the DX Today Expert Report. Today, we're diving into what is arguably the most significant operational shift in the insurance sector since the internet itself. We are moving past the hype of generative AI and entering the era of agentic AI. To help us break down this report on the current and future impact of autonomous agents, I'm joined by our exec fellow, Mike. Great to have you here.
Good to be here, Alex. It's a fascinating time. For the last couple of years, we've been talking about AI as a tool for content, summarizing emails, drafting policies. That was the generative era.
But 2025 changed the game. We are now seeing systems that don't just talk, they act.
That distinction is really the core of this report. But for our listeners who might be used to ChatGPT, how do we technically define agentic AI versus the generative AI they know?
It comes down to one word: agency. Generative AI is passive. You give it a prompt, it gives you text or an image. It waits for you. Agentic AI is autonomous and goal-seeking. It perceives its environment. It reasoned on how to achieve a specific goal, and crucially, it uses tools to execute that goal.
So instead of a chatbot just summarizing a policy document, an agent does what?
An agent notices a claim has come in. It verifies the policy coverage. It might pull external weather data to confirm the storm actually happened at that location. It calculates the payout, and then it actually initiates the bank transfer. It's executing the workflow, not just describing it.
That is a massive leap in capability. And looking at the history mapped out in the report, this feels like the fourth distinct era of automation.
We had the digitization phase in the 90s, the predictive analytics phase in the 2010s, and then that brief Gen AI copilot window. Exactly, and the limitations of those previous eras explain why this is happening now. The early digitization relied on RPA, robotic process automation. That was great for data entry, but it was brittle. If a rule changed, the bot broke. Then predictive analytics gave us great risk scores, but it couldn't act on them. Agentic AI combines the intelligence of large language models with the ability to execute API calls.
It's the engine behind things like Project Nemo at Allianz or AI Gym at Lemonade.
Let's look at the market analysis here. The report cites a Celent survey indicating that 22% of insurers plan to have agentic solutions in production by the end of 2026. That is a very aggressive adoption curve.
It is, but you have to look at the drivers. First, there's immense pressure on cost ratios. Inflation is driving up repair costs, and social inflation is driving up settlements. Carriers need to decouple growth from headcount.
You simply cannot hire enough humans to scale at the pace the market demands, especially with the talent shortage we're seeing as older adjusters retire.
And customer expectations are the other side of that coin.
Right. If you can get a refund from Amazon in seconds, waiting 3 weeks for an insurance check feels archaic. We're seeing early adopters hitting claim settlements in literally 2 seconds. That's the new benchmark.
I want to get into the nuts and bolts of how this works. The report describes a technical deep dive into the architecture. Can you walk us through that? It's not a linear script. It operates in a loop. First, there's perception. The agent ingests a trigger, like a first notice of loss email. Second is reasoning. The brain analyzes the context. Third is tool selection. The agent decides, I need to check the policy database, so it selects that specific API. Fourth is action. It makes the call. And finally, observation. It reads the result. If the result isn't what it needs, it iterates and tries again. So it's self-correcting to an extent?
To an extent, yes.
And we aren't just building one superbrain to do everything. The prevailing design pattern is the multi-agent system, or AAS. You don't have one AI handling a claim, meaning you have a team of digital employees?
Precisely. You might have Agent A acting as triage, categorizing the claim. Agent B is solely focused on fraud, checking databases. Agent C is the adjuster, estimating damage from photos. And then Agent D is the orchestrator, synthesizing all that work to make a recommendation.
That sounds incredibly efficient, but also complex to integrate. The report highlights legacy debt as a major hurdle. Most insurers are running on mainframes from the 80s. How does a modern AI agent talk to a green screen mainframe?
That is the multi-million-dollar headache. You can't just plug GPT-4 into a mainframe. The solution emerging is the wrapper approach. Insurers are building API layers, using tools like MuleSoft to wrap those old core systems. This allows the modern agent to reach in and retrieve data or update a ledger without breaking the core system.
Let's talk about who is actually doing this right now.
The report details a few case studies. You mentioned Allianz earlier. Yes, Allianz's Project Nemo is a prime example of that multi-agent system we discussed. They focused on food spoilage claims in Australia, high volume, low complexity. They used 7 specialized agents working sequentially.
And the result?
They dropped processing time from days to hours. But interestingly, they kept a human in the loop for the final payout decision. They used the agents to do the heavy lifting, but a human pressed the pay button to ensure empathy and accuracy.
Contrast that with Lemonade.
Lemonade is the AI native approach. Their bot, AI Jim, handles the entire lifecycle. They claim a world record settlement of 2 seconds. They use computer vision to analyze video submissions for fraud cues, microexpressions, inconsistencies, and if it passes, the money is sent. It's a touchless resolution.
Then there's Zurich, which seems to be taking a hybrid approach.
Zurich is interesting because they deployed Voice IQ, which is a real-time copilot for call center staff.
It listens to the call and suggests retention offers live on the screen. It helped increase retention success by about 20%. That's a great example of AI augmenting the human rather than replacing them.
It sounds revolutionary, but we have to talk about the risks. The report is very clear that this transition is not without peril. We have major regulatory deadlines looming in 2026.
This is the critical wake-up call section of the report. The EU AI Act becomes fully enforceable for high-risk systems in August 2026.
What does that mean for the carriers?
It means strict data governance, detailed documentation, and mandatory human oversight. If you don't comply, the fines can be up to 7% of global turnover. That is a company-ending number for some.
And in the US?
The US has the NAIC Model Bulletin, adopted by about 24 states so far. It requires insurers to establish an AIS program, Artificial Intelligence Systems Program.
That sounds like a nightmare for underwriters.
It is. Imagine an autonomous underwriting agent hallucinates.
A request and inadvertently offers coverage for a risk that should have been excluded. If the agent issues that binder, the carrier is liable. And here's the kicker. Traditional errors and omissions policies might not cover machine error without specific endorsements.
That leads into the ethical concerns as well. If an agent is trained on historical data, and that data contains historical discrimination, like redlining, the agent will replicate it.
Not only replicate it, but scale. A biased human adjuster can only handle a few claims a day.
A biased agent can discriminate against thousands of people in minutes. That's why meaningful human control is becoming the legal standard. You cannot just let the black box run wild.
So, looking ahead, the report forecasts the years 2027 to 2030. What does the Future Outlook section predict?
We're going to see a shift toward open-ended agents. Right now, agents follow a workflow. By 2027, you'll be able to say, analyze our portfolio exposure to the new wildfire model in California and recommend pricing adjustments, and the agent will figure out the steps to get there.
And the concept of intercompany agent markets.
This is the sci-fi part that's becoming real. We will likely see agents from brokers negotiating directly with agents from carriers to place risks in milliseconds, a high-frequency insurance marketplace, machine to machine.
That changes the landscape entirely. To wrap up, Mike, based on this report, what are those strategic recommendations for insurance leaders listening today?
3 steps. Before you deploy the tech, build the rules. You need to know exactly when a human must intervene. Second, modernize the data layer.
Walk before you run.
Exactly. Let the agent draft the email or calculate the loss, but make a human sign off on it. Only move to full autonomy once that agent hits 99% accuracy in shadow mode.
It's clear that agentic AI is the path to the zero back office insurer, but the engineering and governance rigor required is immense.
Absolutely. The winners won't just be the ones with the best code, but the ones who integrate these agents safely into a human workforce.
Mike, thank you for breaking down this expert report for us.
My pleasure, Alex.
And thank you for listening to the DX Today Expert Report. We'll catch you on the next deep dive.